Once again, the custodians of the euro area's monetary sovereignty find themselves weighing the delicate balance between nurturing economic growth and reining in upward price pressures. As the European Central Bank convenes under the Portuguese sun in the picturesque town of Sintra, its President Christine Lagarde has sounded a note of prudent restraint amidst the clamor for more accommodative policies. In her sagacious opening remarks, Madame Lagarde acknowledged the lingering uncertainties that cloud the inflation outlook, even as the robust job market provides a buttress against more dramatic action. The ECB's own projections, she reminded us, are but one input into the judicious deliberations of the Governing Council. A technocratic over-reliance on specific data points would be an abrogation of their mandate as stewards of monetary stability. It is a conundrum as old as central banking itself, how to nurture the fertile grounds of economic expansion without allowing the virulent seeds of excessive price growth to take root. The ECB's deft hand must walk the tightrope, balancing the Scylla of anemic growth and rising joblessness against the Charybdis of a wage-price spiral that could imperil the hard-won credibility of the monetary union. The siren song of easy money policies has lured many a central bank onto the shoals of economic instability in the past. Lagarde and her counselors would be wise to heed the ancient mariner's tale from that institutional nestor, the Bank for International Settlements. The venerable Basel-based conclave has cautioned against too rapid an easing, lest the inflationary gin escape once more from its bottle. For the disciplined navigators at the ECB's helm, their true lodestar remains that most cherished of targets, the sacrosanct 2% inflation rate, talismanic symbol of monetary probity and price stability. Undershooting risks economic sclerosis and a plunge into the dread liquidity trap. But overshooting could unravel the very fabric of behavioral norms and shake the foundations of fiat money itself. The initial steps towards policy normalization must be handled with the utmost judiciousness. Each fresh data release is scrutinized for portents and augurs by the vigilant centurions of Frankfurt. Yet Lagarde has reminded us that no single indicator can be allowed to hypnotize the Council into a policy stance that may prove precipitous when viewed through the wide-angle lens of the fuller economic picture. The robust employment situation affords the ECB a degree of latitude to assess the multiplicity of crosscurrents roiling the economic seas. Wage dynamics, productivity trends, and those seismic supply shocks that can buffet even the most stable of economic vessels. All must be weighed and synthesized into a coherent policy navigational chart. For even as headline inflation appears to have crested below the dreaded 3% boundary, the shadows of lingering uncertainty stalk the corridors of the Euro Tower. The nexus between corporate profitability, worker compensation, and output efficiency remains opaque, cloaked in the dense fogs of economic unpredictability. Will the virtuous cycle of rising wages catalyzing increased consumer spending take hold, fueling a self-sustaining economic expansion? Or will profits be squeezed in a margin vice as expenses outpace revenues, presaging a future retrenchment that could choke off the recovery? Only time and vigilant examination of the unfolding data can unlock such mysteries. Then there are the tectonic rumblings from below, those supply-side shocks that can swiftly alter the economic terrain. A festering geopolitical quagmire, an unexpected shock to global commodity flows, or a climatic upheaval with systemic economic impacts. Any such tremor could send policy engines into a new and uncharted gyre. In the face of such manifold uncertainties, Lagarde and her cohort have signaled a commendable posture of watchful inertia. Their determination to remain data-dependent, eschewing a pre-committed policy glide path, evinces a philosophy of principled pragmatism. For does not this world present a perpetual stream of surprises to the learned forecaster? Is not the essence of wisdom found in a supple receptivity to each fresh, unfolding reality? The annals of monetary history are littered with the wrecks of central banks vanquished by the fallacy of intransigent policy commitments. No, far better for the ECB to preserve its optionality in the face of an unrefusedly protean economic environment. Each policy window must remain wedged open to changing circumstance and evolving risk assessments. When the lodestar of 2% remains occulted by the billowing clouds of inscrutable data, the prudent captain must slacken sail rather than hazard the reefs. To rush headlong into an easing cycle would be to risk inflating future imbalances that may prove harder to subdue than this present flare-up. Each accommodation increases the likelihood of growing private sector dependence and deepening market distortions. At some point, that pernicious addiction must be broken lest a far graver economic illness take hold. And so Madame Lagarde and her cohort have elected to bide their time, allowing the economic metrics to percolate and the productive forces to regain their equilibrium. They will remain vigilant, as she intoned, permitting their future bias to be informed by, but not limited to, their own forecasts. It is a stance of humble deference to the intrinsic complexity of macroeconomic steering. No model, no matter how sophisticated, can capture the full depth of an organic economic reality teeming with autonomous human agents. The captains must observe and infer, adjusting the trim in gradual increments as the prevailing winds demand. For those voices clamoring for more decisive action, prudence and proportion must be the watchwords. The ECB's determination to remain unshackled by a rigid reaction function stems from their role as guardians of the European monetary province. Their obligation extends beyond the transitory data squalls to encompass that far horizon of durable economic and financial stability. In this, let none accuse Lagarde and her mariners of complacency or dereliction. Rather, it is the institutional restraint born of seasoned experience and a sense of humility before an economic world far too complex for arrogant prediction or swashbuckling policy audacity. The paradox of our contemporary central banking age is that the greatest triumphs are frequently those unsung pauses of prudent inaction. The undramatic holding of monetary course amid the blaring squalls for momentary gratification. For in economics as in life, wisdom is so often found in the path of considered moderation. As the Sintra policy conclave breaks in the fading Portuguese light, its deliberations enshrouded in a merciful cloud of inscrutability, we would do well to retire our facile criticisms. For in the hallowed sanctum of the Eurotower's council chambers, a great work of patient statecraft proceeds apace. Vigilant and wary, Lagarde's centurions stand eternal watch o'er the monetary ramparts of Europe's socio-economic citadel. Unbowed by the howling rhetorical winds, they alone remain to guard that most precious of civilizational treasures, the steadfast credibility of the currency itself. So let the inflationists and painless money cranks rage against the principled restraint of the ECB. For in its captain's carapace of judicious forbearance incubates the fragile seed of lasting financial and economic security. And is not that nurturing shelter the foundational promise upon which all societal prospering is reared? In this hoary maxim, breathed down through the ages, lies the core truth that monetary prudence, so unglamorous in its time, stands eternal sentry over the social prosperity each generation bequeaths to the next. It is no trifling charge, but the sacred duty of any ascendant civilization.